Welcome to Trader TV Fixed Income, your insight into the trading climate for professional bonds investors. I'm Dan Barnes. Securities lending and repurchase agreements are crucial tools for managing liquidity for the buy and sell side. In October's show, we're talking to Roelof van der Struik, Manager for Treasury Trading and Commodities at pension fund PGGM, about his firm's efforts to deliver greater efficiencies in its securities financing operations, plus Tom Harry at MTS and Steve Holland at UnaVista about the impact that securities financing transaction regulation will have upon securities financing and ultimately upon investors. Roelof, welcome to Trader TV.
Thank you for having me, Dan. Good morning as well.
Tell me, why are repo and securities lending so important for your investors?
Security finance has two functions within PGGM. Securities lending is mostly seen as incremental income for our funds, and repo is often seen as a way of switching between liquidity and creating liquidity in the market when needed.
And where are asset managers currently exposed to risk in their securities financing operations?
The market is broken. In that it sounds very dramatic, and in some ways it is. Through regulation and fiscal policy, the banks no longer can fulfill the role they used to fulfill in market making and providing liquidity to the market. And this becomes painfully obvious during certain regulatory reporting dates like end of year, end of quarter, where, especially end of year, where the repo market closes down completely. And this has caused PGGM major problems.
And how's PGGM been working then to manage those risks?
We used to have a repo book of between 12, 14 billion euros at any certain time. But as we can no longer bring those funds over year end in the repo product, we have had to scale down our repo book considerably. Now we only have a repo book of about 3 to 4 billion.
And are you working with sell-side firms to try and increase the efficiency of the market and the way you are able to work?
I think what we are figuring out is that we are going to have to develop more of our own plumbing and create liquidity in places where it isn't affected by the bank balance sheet. So we have recently started quite a large project called Collateral Roadmap. Mm-hmm. And within this project, we have identified certain ways that we can get back some of the liquidity that we've lost over the past years. The first initiative that I led was cleared securities lending. We have become a direct member to the Eurex CCP, and we went live with that this summer. We still have some teething problems, but we are tackling those at the moment, and it's all looking good. But we're also going for cleared repo with Eurex, and that's at the moment full in implementation. But it does mean that we have to create some of our own plumbing and connect to certain flow providers and these kind of things. So it's got a lot of investment and work. I would say that by the end of next year, we should really be seeing reap the fruits of what we are doing at the moment.
Over time, what sort of benefits do you think you're going to realize?
Well, I think first it's not even benefits; it's just fixing what was broken. Yeah. It's a new regulatory framework that we're working at the moment. So it's bringing us back into the same position we were before we were faced with a market which is not functioning as it should be.
How will this affect end investors ultimately?
If there's going to be a crisis or there's going to be an event, let's make sure it's not at year end. Because if that happens, then I think the fertilizer will definitely hit the air conditioning in a big way.
Is it fair to say the market needs to see greater electronic trading and plumbing initiatives to enhance efficiency.
Yeah, absolutely. And there's some other initiatives as well, of course. We have at the moment quite a few peer-to-peer initiatives in the market. We are looking into them as well. But we have decided to first go the CCP route. The reason being is that would seem more like the route that the regulator wants us to go.
Do you think the regulatory awareness of the challenges in the market structure, do you think the awareness is there of the seriousness of the problems?
I once spoke on a panel with a lady from the ECB, and she said, on average, liquidity is good. And I said, yes, I could be dead 10 minutes, but on average, my heartbeat for the year would be perfect. I think that's the situation we're in. I mean, on average, everything's fine, but as I said, year end, quarter end, the liquidity in the market is problematic at best. Don't forget, I mean, in times of normal market conditions, no well-rated party wants cash. But that's again, when the fertilizer hits the air conditioning, nobody wants bonds, everyone wants cash.
Yep.
Need some method of transforming between those two.
Roelof, thank you very much.
It was my pleasure. Thank you very much for having me.
Now we're going to speak with Tom Harry at MTS and Steve Holland at UnaVista about the impact that securities financing transaction regulation will have upon investors. Tom, Steve, welcome to Trader TV.
Thank you.
Thank you.
So, Tom, can you tell us, to start with, what is securities financing?
Well, very broadly speaking, securities financing covers the borrowing or lending of a security for cash, or vice versa. It is really difficult to understate how important securities financing is. Today's financial system would not exist without it. For example, market makers rely heavily on borrowing securities through securities financing when they don't have a security in the inventory. Many institutional investors lend out surplus cash and securities to enhance their returns. So very clearly, it's a very important function in today's financial system.
So where are there barriers to enhancing the efficiency within the securities financing team and the trading team?
Given the complexity of the characteristics of the different contracts and the legals available for securities financing transactions, and then the life cycle events that often have to be managed, such as the margin provision and collateral management, this has resulted in a large number of bespoke systems and manual processes, which naturally leads to inefficiency and can erode the benefits of securities financing. But this is part of the reason why initiatives such as MTS Repo have come into being. MTS Repo having been around for 20 years, partly to address some of these issues and to provide electronic trading solutions and straight-through processing, so to mitigate some of the inefficiencies that have arisen.
Are there any sort of regulatory barriers or regulatory developments which might impact efficiency in the markets?
The next big regulation on everyone's agenda is SFTR, which is going to be the regulation to make securities financing transactions reportable to the European regulators.
Yep.
It's going to be a big change to the industry because currently they don't have any reporting regime at all. They also, these are often done by multiple teams within a bank or multiple systems. So it's going to be a big change for those people to get their data reporting in order for when this goes live in Q1 2020.
If SFTR is going to enhance transparency, that's presumably a positive for the industry.
Yeah, I mean, we saw obviously in the crash in 2008 that the position of people like Lehman Brothers was massively underestimated, and most of that was due to the securities finance transactions that they'd entered into with their counterparties.
Yeah.
So making that more transparent to regulators will mean that in the future that's less likely to happen, and everyone will know the positions before something like that could happen again.
And are there risks that it might create?
Yeah, there are some risks. Obviously, they've never had to report those transactions before. There's a lot of data that the regulators are asking for that not all parties that have to report necessarily have at this moment in time.
Yep.
So they're going to have to do a lot of work to either create or model those data fields or get them from other areas or other counterparties for them to be able to report. So it's going to be a big undertaking, I think, for firms.
I think it's very important to also recognise that there is a potential opportunity for firms to finally recognise the complexity of this function and to bring greater linkages between their systems to achieve greater integration and therefore to realise greater returns, partly thanks to the work that they do alongside getting ready for SFTR reporting.
And how do you see firms managing the process at the moment?
It's a big undertaking. I think the thing to also remember is that a lot of firms, and we've seen this in the past with EMIR and MiFIR, they try to get their reporting sort of perfect but forget the reason why they're doing it. So the regulators, we understand, don't want to see a perfect example of reporting. They want to see books of record data, warts and all. They don't want it sanitized. So it's important to remember that it's not just reporting for the sake of reporting. It's to give a clear position of your books of record on a daily basis.
Pulling all that together, it sounds like there are a number of challenges in aggregating that sort of data and making it useful.
It's over 150 fields of data. Which, as I said before, a lot of firms don't have all of those fields, so they're going to have to look at either getting that data from counterparties, etc., or in terms of a lot of them as the reuse data, the reuse of those securities. They don't necessarily track it in the way that the regulator wants it reported.
Right.
So they're going to have to either model that data or come up with a way of tracking that, and that's going to be quite. We've seen through the industry groups there's quite a lot of discussion about how that's done, because obviously if everyone does it in a different way, then the data will be all over the place. So it's important that the market comes together and agrees on how these fields or how this data will be calculated, modelled, etc.
How do you think SFTR might impact the sell side to buy side relationship?
It's a very good question. As one today, the dealer to client market, especially for repo, is one that's very manual, but still very much over the phone or by chat. And I think SFTR is going to be the item that really pushes this market towards the electronic space, because the need to ensure that you report correctly, in addition to the need to achieve greater efficiencies, will really make electronic trading in the dealer to client space a lot more appealing. And certainly that's something that we have started to notice with our dealer to client offering, GCM, where we're starting to see a lot more traction, interest, thanks to SFTR and thanks to the efficiencies electronic trading provides.
Steve, Tom, thank you.
Thank you.
Thank you, Dan.
I'd like to thank Roelof van der Struik from PGGM, Tom Harry at MTS and Steve Holland at UnaVista for their insights into how to drive efficiency in securities financing, and of course you for watching. To catch our monthly reports on other markets or to subscribe to our newsletter, go to tradertv.net.